Good afternoon, everyone. Thank you so much for joining us today for HB Wealth's Year-End Planning webinar. I'm Kelly Nowotnick, a Senior Wealth Advisor at HB, and I'm joined today by my esteemed colleagues, Abby Flaum, Wealth Strategist, and Tim Talek, the Director of Tax Planning and Family Office Services. All three of us, notably in our former lives before joining HB Wealth, practiced law in the tax and estate planning area. So we really are thrilled to have you here for this important and timely conversation around year-end tax-driven planning. We've had an unbelievable response, which tells us that everybody's already in year-end mode. And there were quite a number of questions submitted in advance of this webinar. So we have tailored the presentation to answer as many of them as possible. Thank you for your engagement. That said, if you submitted a question that goes unanswered, please reach out to your advisors at HB Wealth. As an advisor at HB Wealth, I can tell you we are all deep in year-end planning mode and eager to make sure all of your questions are answered. So don't be shy. To give you a little roadmap of this next hour or so, first, Tim is going to give a very brief overview of some legislation, the One Big Beautiful Bill Act, that went into effect over the summer and made some changes to the income tax and transfer tax landscape. Some of those changes take effect this year in 2025, and some take effect next year in 2026. But in either case, it makes 2025 an especially important year to be very thoughtful around year-end planning. Then I'm going to lead a Q&A in which Abby will answer some of our estate and gift tax questions related to year-end deadlines and planning. And Tim will speak to some important income tax planning items that were impacted by the One Big Beautiful Bill Act. We'll wrap up the call with some year-end planning items that are important to address in any year, regardless of the legislative landscape, and some best practices for having family meetings around this time of year as people gather together to celebrate the holidays. So with that, I will turn it over to my colleague, Tim Talek, and let's dive right in.
Thank you, Kelly. I don't know that I've ever been referred to as an esteemed colleague, but thank you for that.
You got it.
I like it. I like it. So just wanted to spend a few minutes, while it has not been front page news, the One Big Beautiful Bill Act for a number of months now, just to re-level set really on its purpose, and some of the implications, and some of the sausage making, if you will, that went into the bill's passage. The One Big Beautiful Bill Act, and we'll use OBBBA, we'll use OB3, we'll use a few the Act interchangeably throughout this presentation. But really, in thinking about this legislation, if you recall, it passed with much publicity and great fanfare. It was signed into law on July 4th with fireworks ablazing behind the president. And like our last three major pieces of tax legislation in the United States, the bill itself was passed under the budget reconciliation process, which, as we all know now, having lived it for the last 20 or so years, every major piece of tax legislation has been passed utilizing budget reconciliation, which basically means the party in power can steamroll the other party. Both sides have done it with a simple majority vote. So lo and behold, we know we have we don't have a divided Congress. We have a Republican-led Senate, House, and presidency right now. And so the One Big Beautiful Bill Act, needless to say, reflected a lot of the priorities and platforms of the Republican Party. The real focus, while it was really kind of litigated in the press of this terrible possible outcome if this wasn't passed, it was really a self-created, and it has been the case under budget reconciliation. These tax bills over the past several cycles have been passed on a 10-year sunset or 10-year expiration. So every time a major piece of tax legislation has been passed, it only has so much shelf life, if you will. So this somewhat was a self-created crisis by all of our politicians in Washington. And we heard, if we hear sunset used more in the press, I think it's going to spoil going to the beach for all of us. But anyway, with the Tax Cuts and Jobs Act that was enacted in 2017, most of the provisions under the TCJA were on the brink of expiration at the end of this year. Not passing the OB3 in 2025 would have both politically and economically been very disruptive, significantly hiking income tax rates, really rolling those rate structures, brackets, deduction levels, etc., on a pre-inflation adjusted basis back to where we were in 2017. And really importantly, for purposes of individuals, slashing the estate gift and generation skipping tax exemptions, and rolling those back to, if you can remember, back when those exemptions were at or around the $5 million level. So this crisis was averted. With the passage of the One Big Beautiful Bill Act. So while many of the income tax provisions of the act seem to be relatively minor in the grand scheme of things and seem to simply tweak some of prior law, when you look at all of the provisions in the 900 plus pages of legislation that we ultimately got, cumulatively, they tend to distort and blur really the current administration and prior administrations' tax policies and themes that over the last 10 years, we were trending towards a minimization or elimination of itemized deductions. How do we write some of the legacy and historical special interests out of the tax code that have accumulated over the years? And really with the focus on simplification of the overall tax system and the tax code. With the president and others in Washington even coming forward and with an end goal stated objective of reducing our 1040 tax compliance forms down to a postcard sized tax form. So while that was the goal that they set out to attain, in reality, the One Big Beautiful Bill added significant amount of complexity to tax planning, really attributable to inconsistent deduction phase-out levels, new hybrid deductions, which we'll talk a little bit about when we get into the meat of the income tax discussion. It's triggered several interrelated calculations that taxpayers are forced to, or advisors to taxpayers are forced to grapple with, and a number of new effective dates. And lastly, of course, what would be a good piece of tax legislation without a new series of sunsets, which are staggered over the next 5, 7, and 10 years. So there's something in this bill for everyone. It is seemingly relatively simple piece of legislation, as it resulted in a continuation of many of the Tax Cuts and Jobs Act provisions. But several of the tweaks that were made have introduced a high degree of complexity, requiring a new precision as we look at year-end tax planning. So with that, I'm going to turn it back to you, Kelly.
Thanks, Tim. It was great for you to set the stage. It's important we all understand that the One Big Beautiful Bill Act was passed this past summer and will impact some of our year-end planning items and discussion. But I'm going to turn this to Abby now. So Abby practiced for many years as an estate planner in private practice, and now advises many of our families as they craft their estate plans with their attorney. So she is sort of uniquely situated to answer estate planning questions. So I'm going to put you on the spot here, Abby. When we hear about year-end tax planning, most of us automatically think income taxes because so many year-end checklist items are income tax driven. However, we don't want to forget about estate taxes. And for the last 7 years, we've all been hearing about the sunset, meaning the time when the estate tax lifetime exemption was going to be slashed in half. So for many of our HB clients on the line, as you've been meeting with your advisors, you've probably heard them over the last few years talking about this looming deadline, which was December 31st, 2025. So my question for Abby is, did the One Big Beautiful Bill Act change that? Is the sunset still relevant? And to the extent it did change it, what's in place now?
Well, thanks, Kelly. And I don't know why everyone doesn't sit around talking about the estate tax all day. But I do want to make sure, and we have a large audience on this call, so I want to make sure everyone's on the same page. So some of what I'm about to say is a little too basic for some of you. You'll forgive me and please bear with me, but I do want to make sure we all have the same foundation. So a married couple, and this remains true under OB3, a married couple can give whatever they want to each other, completely gift and estate tax free. But there is a limit on what a person may live to anyone that's not their spouse. And, Kelly talked about, and Tim talked about the last tax act we had under Trump 45, which was the Tax Cuts and Jobs Act. And that was passed at the end of 2017 for 2018 and moving forward. And what that did was it changed the estate exemption, which at the time was around $5 million, and increased it to 10, adjusted for inflation. What does this all mean? Okay. We all have stuff. When we talk about what an estate is, your estate is just your stuff. Everything you own, house, your bank accounts, your retirement accounts, your life insurance, vacation homes, your business, everything you own is your stuff. And that's your estate. And like I said, you can leave as much of that as you want to your spouse if you're married. That's just the rule for spouses. The limit on what we've been able to leave to anyone that's not our spouse in 2025 was a pretty high limit. It was $13.99 million. And that's per giver, not per recipient. You can't leave each of your kids $14 million. But if you're married, you and your spouse combined were able to leave about $28 million to your kids or whoever you leave your estate to, completely estate tax free. And by the way, with this exemption, as we call it, you can use it during life, at death, or in combination. So, and some of my clients have heard me give an example like this before. If we all hang up from this webinar and you say, that Abby Flaum is just the most brilliant, beautiful, fabulous person I have ever seen on any webinar, and I would like to give her $10 million. Thank you. You would cut me a check for $10 million. And then you would report to the government on a gift tax return that you gave Abby Flaum $10 million. What would happen is that 10 would be subtracted from the 13.99 that you have right now, leaving you $3.99 million to give to, I don't know, Kelly and Tim. So that's how it works. Under the One Big Beautiful Bill Act, that 13.99 will increase to $15 million per person, per donor, per giver. So 30 for a married couple. And it will adjust upward with inflation after 2026. So to answer your question, Kelly, yes, OBBBA changed where the laws were going because that 13.99 was supposed to sunset and go back to pre-Tax Cuts and Jobs Act levels. And we were all frantically trying to plan with all of the uncertainty. And this is where we are now.
So thank you so much, Abby. A follow-up to that is, if I'm one of your clients and I'm thinking, well, gosh, we were working so hard to fund these trusts and make these gifts before the end of 2025, thinking we had to capture this unique opportunity, this historically high exemption level, because it was going away on January 1st, 2026. And now it's no longer going away. In fact, it's increasing as of January 1, 2026. Should we pump the brakes? Was it all a waste of time? Can you speak to that?
Can I speak to that? Of course. So first, let me just, when the One Big Beautiful Bill Act was passed, all of the articles, including from us, coming out were that, what's happening with the estate tax laws is permanent. And I'm going to use my air quotes here. That's permanent, right? Because just like with any kind of tax bill and any kind of administration, it's permanent until it's not permanent anymore. So what I will say is this: since the Tax Cuts and Jobs Act passed 7 years ago, we have been operating in this murky cloud of uncertainty, and we were worried the exemption was going to decrease. And by the way, everybody, for those of you who haven't been following it, the exemption was not always several $1 million. When I started practicing law, I think it was $600,000. So the estate tax affected far more people then than it does now. But even then, it was still a really small percentage of the American public. This act has passed permanent laws, but what does that mean? It means maybe we have a little bit more certainty, right? We're all pretty certain that this will probably hang around at least until President Trump's term is over. So that gives us a few years. But for those of us who are doing the hurry up and plan sort of activity, this doesn't mean it's time to pump the brakes for several reasons. First, if you're not taxable, if you're nowhere near that $15 million limit, I will say that it's very possible, maybe even use the word likely, that you might have tax planning provisions built into your last will and testament that might actually be more harmful than helpful at this point. And what I mean by that is a lot of people who have done their wills in recent years have an estate tax deferral scheme built into their wills at the expense of income tax planning. So what this means is if you don't have estate tax to worry about, your will should be structured in an income tax efficient way. You don't need to remember that. You don't need to remember anything technical other than having a talk with me if we work together, your advisor, your CPA, your attorney, to say, do I need to update my estate documents to build in flexibility to move with the tax laws? Many of you, I can promise, have tax planning that's baked into your documents that is now inappropriate for you. And you can create documents that have flexibility built in to move with the tax laws so that you won't have to redo your documents every time the tax law changes. So that's talking about non-taxable clients. For those of you who are taxable or may become taxable, and let me remind you, this means we are counting up everything you own, your houses, your insurance, your accounts, all the stuff, right? And we're thinking about the fact that you have wonderful advisors that are going to invest it well, and hopefully it will grow. We're also thinking about people who may wind up having liquidity events. We're thinking about life insurance that adds into your taxable estate potentially. We're thinking about all kinds of things that may render your estate taxable. For those clients, we are here to work with you, to continue to work with you in structuring how best to use your exemptions, because there's good and better ways to use your exemptions and maybe even some bad ways. Let me remind you that if you remove $1 from your estate today, and that dollar grows to be worth $5 a few years from now, you have removed that $4 of growth from your estate plan. So the sooner the better on transfer planning. And then for other people, taxable or not taxable, a lot of people talk to us about wanting to move wealth out to their kids in an efficient way. Sometimes we're doing this through the use of annual exclusion gifts. That's the $19,000 a year that you're allowed to give to anyone you want that does not eat into your estate exemption. If you're watching this webinar and you say, wow, Kelly, Tim, Abby, and all of HB with the 300 something employees are fabulous, I would like to give them each $19,000, you can do that. And it has no transfer tax consequences to you whatsoever. Similarly, you can pay for anyone's education. And as long as you pay directly to the educational provider, it is a tax-free gift. So if your best friend's cousin's nephew's roommate is going to go to Vanderbilt, which is like $100,000 a year, I think, and you want to pay for it, as long as you cut the check to Vanderbilt directly, you can do that. There are no transfer tax consequences. The same goes for medical gifts cut directly to the medical provider. And of course, more significant gifts above that would be, maybe to irrevocable trusts that benefit your descendants, your spouse, could be charitable trusts. There's no one answer that fits every client, which is why it's really a discussion. But Kelly, really to answer your question, because I've just been yapping over here, it doesn't matter if the transfer tax is X, Y, or Z. Achieving personal goals, ensuring assets flow the way that you want them to when you pass away, appointing the right people to be in charge of carrying out your wishes, preventing family friction, all of these things always remain important. And I would say that now that we have a certain level of certainty, this is really the time to, stop organizing your sock drawer and sit down and talk about what you want your estate plan to look like.
I think you just revealed yourself, outed yourself as a New Yorker, Abby.
It's my worst
Your
word.
drawer. No, that was very well said, very helpful. Thank you so much. I'm going to turn it over to you now, Tim, to speak specifically, not to just year-end planning best practices, which we will talk about towards the end of this call, those practices that are important year after year after year to be thinking about, but specific to the One Big Beautiful Bill Act that passed this past July. What are some unique changes, opportunities, challenges that we should be thinking about before the end of 2025, given this new legislation?
Yeah, thank you, Kelly, and thank you, Abby. Unfortunately, the income tax code is not replete with opportunities for me to ask for you to give me $10 million. Abby was able to do that. The income tax is a lot more dry, a lot more methodical.
We should, not to interrupt, but we should caveat that we do not accept gifts or bequests.
Yeah, absolutely.
It's all just hypothetical. But
what we will do to echo Kelly's note is to kind of walk through some of the mechanics of changes that were made, both extended provisions and new changes, modifications that were made to the income tax portion of the OBBBA. So let's spend a few minutes walking through the key income tax provisions and really how they might impact individuals. As many of you are, and many of you know, many individuals own small businesses. So a lot of these provisions really hit home in small business planning as well, and how that interacts with individual tax planning. And then, not to step on family toes, Abby did an excellent job covering that, but thinking about some of the opportunities on the income tax side to coordinate and support family members, particularly some changes around the education 529 education planning, which came out of this bill. So first, to start with the really deductions and charitable contributions, which I think have gotten a lot of publicity. The OBBBA makes several changes permanent now. permanent, using Abby's air quotes. To itemized deductions, the enhanced standard deduction, which we've enjoyed since 2017, and the charitable contribution, by both building on and modifying several of the provisions that were introduced and enacted in 2017 under the old Tax Cuts and Jobs Act. We'll start with the standard deduction, which, given its elevated level, I think the last statistic I saw through the IRS pointed to roughly 88 or 89% of Americans file utilizing the standard deduction. So the standard deduction, as of 2025, for a single taxpayer, you get, regardless of whether you save your receipts in a shoebox or not, does not matter. You can file under the standard deduction as a single taxpayer and get a free $15,750 standard deduction. That deduction is doubled for married filing joint filers, so $31,500. And really the rationale behind that was with that elevated, along that theme of simplicity, with that elevated standard deduction, which does not require significant documentation and substantiation. The goal was to really simplify the tax filing process for most Americans. So as simple as that sounds, in addition to the standard deduction, there's a new and improved temporary deduction for qualified individuals over age 65. This adds to a single taxpayer $6,000 to that base standard deduction level, or $12,000 for a married senior couple over age 65. Those standard deductions, and I talked earlier, I mentioned hybrids, which is relatively new in the world of the income tax code. This additional standard deduction is actually subject to several of the phase outs that many of us are familiar with from the years of itemizing and working our way through itemized deductions and substantiating things like our charitable and mortgage interest and state income tax and other business expenses, and going through that process every year. So while this is positioned as an enhanced standard deduction, it still has phase out levels. So for a single filer, a single senior filer with let's call it taxable income, the technical term is modified adjustable income, or AGI, of $75,000, that benefit begins to phase out, and that deduction ramps down. Similarly, at $150,000 for joint filers, that deduction starts to phase out and ultimately ramps down, I believe completely phased out around between $250,000 and $300,000. So additionally, in addition to the change or the permanency of the standard deduction regime, the OBBBA permanently eliminated most of the miscellaneous itemized deductions, with the one exception of educator expenses and the personal exemptions that we all used to claim on page 1, page 2 of our 1040s. So that's no longer most itemized deductions, the personal exemption, are now permanently, we think, put to bed. Most filers will now be faced simply with the decision of claiming a standard deduction, an older taxpayer, the enhanced standard deduction, or itemizing their deductions as they file their annual tax return. The bill also simplifies the overall limitations that we used to be subject to pre-TCJA. You may remember the term the P's limitations, where if you had itemized deductions over a significant level, you would start to lose the benefit of those tax exemptions. This, starting in 2026, rather than going through that complex phase out of the old limitations, beginning in 2026, this tax act imposes a 35% tax benefit, tax rate cap, if you will, on itemized deductions. So for a individual filer who has income of approximately $625,000 in 2026, they and they otherwise itemized their deductions, they would be subject to, rather than getting a 37% benefit for their itemized tax deductions, that deduction is arbitrarily lopped off at 35%. That individual would lose those additional 2 percentage points of tax benefit. That level is 721,000 for married filing jointly, and again, that provision kicks in 2026. The additional for those non-itemizers, one of the provisions that was picked up in the charitable arena is, if you recall, the COVID era non-itemized charitable deduction. So for a standard deduction filer in 2026, the legislation allows for a charitable deduction of $1,000 for single filers, $2,000 for married filers. While, there's always bad news with good news, the yin to the yang of that charitable provision is for itemizers in 2026. There's a new limitation based on your adjusted gross income, which essentially disallows the first 0.5% of your adjusted gross income as it relates to the amount that you're trying to gift to charity. So for simple math, if you were itemizing your charitable deductions, you gave $100,000 to charity, you had an adjusted gross income of $1 million, that 0.5% would be the floor. Essentially, you would lose the first 0.5% based on that $1 million adjusted gross income. So there would be a slight haircut. You would always lose the first 0.5% based on where you fall out from an AGI perspective.
So Tim, just to keep this, close to home and real for our clients, the standard deduction has gotten higher, but even with that, I won't say most, many of our clients still itemize for various reasons. Assuming I'm an itemizer and the market has been performing really well, I have all these appreciated securities in my portfolio, I've always been tinkering with the idea of funding a donor advised fund or supporting a charity that's close to my heart. Would you recommend me giving in 2025 or waiting for a future year? And are there any strategies I can employ to get the most bang for my buck on the income tax side? Even though I'm charitably inclined and it's not income tax driven, I still don't want to lose out on the benefit of a deduction that I might be.
Absolutely, and we'll cover that in a little bit more detail. But yes, there is an opportunity, and this gets to with the new legislation. While there's not that, I think we'll use the term taxageddon year-end planning opportunity, where if I don't do this, the world will end. There is certainly 2025 year-end charitable gifting that can be done and get you to a better tax answer, real dollars in your pocket. That could be either by deploying and thinking about, even if I'm giving directly and not utilizing a donor advised fund, let's go ahead and bunch our charitable contribution deductions in 2025. If we give $10,000 a year to charity and we do that fairly regularly, or we tithe $10,000, maybe budget permitting, maybe think about in 2025 accelerating that $30,000 into 2025, and taking a few years off in subsequent years until you think about and availing yourself of the standard deduction versus itemizing because of those large charitable contribution deductions. Does that answer your question, Kelly?
It does. Thank you. Here's a follow-up, which is really unfair because it's not one that we've discussed. I'm putting you on the spot here. So say I really am charitably inclined this year, and I want to give this year before I lose out on that 0.5% floor next year. But say I give so much that I'm over the limits and I can't capture that full deduction on my return for tax year 2025, and I have to carry forward some of that charitable contribution deduction. What happens next year when the laws change? How does that work?
Yeah, so those carry forwards, it depends. I think it's a great question. I think those carry forwards, you will find those carry forwards subjected. The carry forwards are accounted for after current year giving. So the first cuts, if you will, related to both the 35% cap on itemized deductions and the 0.5% or 0.5% AGI floor on charitable giving gets applied to current year gifts first, to the extent that you ultimately still have capacity carrying gifting capacity to take advantage of those carry forwards. Then you go through a similar analysis on those carry forwards. So you can't sidestep the 2026 tax provisions by saying, well, I'm gonna front load this 5 years worth of carry forward to technically sidestep these
You
limitations.
knew exactly where I was going with the question. That's exactly.
Yeah. No, that's very, very good question. Very good question.
Well, here's a related question. So say my plan had been to front load in 2025 so that I could take the standard deduction in 2026, but then I have a carry forward.
I'm sorry. Can you say that one? Can you ask that another way? I think I heard it as the same question you just asked.
I guess my question is, I was very generous in 2025.
Right.
I put years worth of what I would otherwise give to charity into my donor advised fund in 2025.
Got it.
Because I wanted to avoid that 0.5% floor and any.
I got the question now. Thank you. I'm sorry I missed it. But yes, the donor advised fund, because that is a fully completed gift, subsequent distributions in subsequent years from the donor advised fund are really not going to impact your 1040. So as those dollars flow from the donor advised fund and are not flowing out of you individually, then they would not be subject. Those distributions in subsequent years from the donor advised fund would not be subject to both the haircut or the floor on charitable contributions.
Thank you. And if there was a carry forward from that contribution to the donor advised fund, I would have to itemize to capture that. I couldn't capture that with a standard deduction. You can't have your cake and eat it too.
You would not capture it with a standard. You would not be able to capture it with a standard deduction. Starting in 2026, you will have this either or. I can either take a non-itemized $1,000 or $2,000 direct contribution to a public charity, or I can itemize and really direct those assets both in kind, in cash, to where I want them to go.
Thank you for clarifying that, and I will give you the floor back.
No, that's fine. This is very, very, very good questions. Thank you. The last two things we'll touch on in the realm of deductions, both charitable and non, are the introduction of the tip and overtime, the overtime income deductions. So let's just generalize and say service industry workers have the ability to deduct up to $25,000 of tip or overtime income. There are phase outs that apply. So if you're a tippable, very successful, let's call it server, and you make north of $150,000 a year, you begin to lose, and ultimately that $25,000 deduction phases out as your income eclipses that $150,000 single or $300,000 married. So very, very interesting. It was one of those compromise 11th hour provisions that made it into this legislation, I think, to advance it from the House ultimately to the Senate. And then in the spirit of building in America, the introduction of the $10,000 annual auto loan interest deduction which really only applies up to there's multiple hoops to jump through, but it only applies up to certain levels, purchase levels for cars that are domestically assembled. And that deduction, that auto loan interest deduction, is also subject to phase outs between if you're an earner between $200,000 and $250,000, you're fully phased out and not able to take that deduction. So as you see, while some of these deductions and exclusions, standard deduction, charitable, seem relatively simplistic, they've introduced a certain degree of complexity with each having its own considerations and requiring a certain degree of precision and intentionality as we go into year-end planning. The next area we'll pick up the pace here. Is really the much debated and again a settlement provision in getting this legislation done, which was the state and local tax cap, which, as we know, we've been living with the $10,000. For those of us that itemize deductions, we've been living with the $10,000 cap on the amount of state and local deduction that we could claim against federal income. That limitation is now $40,000 effective for 2025. But because it is an itemized deduction, we couldn't possibly do anything without a phase out. So the SALT deduction cap of $40,000 between the income level of $500,000 and $600,000 of adjusted gross income fully phases out, and you're left with back to the same old $10,000 we've been stuck with for the last 9 years. So income income management and being sensitive to where you're going to be from an adjusted gross income level really will drive at least the 1040 benefits that you can avail yourself of under the new SALT deduction cap. Notably, there was no adverse law change related to pass-through entities. And so what several states have done for higher income business owners that own or manage their affairs through a pass-through entity, a partnership LLC, there is the ability in certain states to pay income taxes attributable to the income the entity generated at the entity level, and have the entity take an unlimited deduction. So for business owners, pass-through entity, the PTET election, as it's often called, the pass-through entity tax election, is still available and certainly still very valuable and a way to sidestep the state and local tax deduction cap.
Yeah, I sit in Maryland, and Maryland is one of those states that has that deduction available, and it's particularly meaningful for in the year of liquidation. If you're selling a business and that business happens to be an S corp, that can be a very meaningful deduction. So I'm very glad the OBBB Act did not do away with that.
Absolutely. If we could bring up, we don't have many slides, but I did, because we covered a lot of ground, I did want to bring a slide up to illustrate this point of even with seemingly simple changes, the complexity. And essentially what this graphic shows is the various provisions we've just walked through, where, depending upon your marital status and depending on the deduction, which taxpayers at what levels of income can actually avail themselves of these deductions. To the left-hand side of these bars, the bars themselves are the phase outs. So as your income increases left to right, at least my left to right, I think we're looking at the same thing, the value of the deduction decreases with phase out. And then to the right of those candlestick or bar graphs, that deduction is complete. You've completely lost any tax planning benefit due to these phase outs, these staggered phased outs. So I mentioned that interdependence and inconsistencies and overlap of these phase outs make things particularly difficult. So I thought quickly I would channel my inner law school professor, and I started thinking, okay, with this chart in mind, how do you compose a tax law test question. And so this is what I came up with. I hope you find it as entertaining as I do. I'm a bit of a tax nerd. So if I were posing a question this year to my new tax law student class, I have a very successful 65-year-old waitress mother-in-law. She works 50 hours a week. She's single but engaged to a younger man with a minor child. She's planning to marry either on New Year's Eve or in early 2026. She lives in a very high tax rate state, is extremely charitable, has amassed a Peter Thiel-sized traditional IRA by day trading between shifts, and has an affinity for driving new Chevrolets. How should she plan to optimize each of these new OBBBA deductions? And while I don't expect the audience to have to answer that question, Abby and Kelly, I will expect your answer later this afternoon.
We'll have to get back to you on that.
Yeah, absolutely.
Quite a go.
Absolutely. I really got a chuckle out of that. I hope you did too. So moving on, we'll quickly cover the alternative minimum tax. It has reared its ugly head again. There's good news and bad news. The changes, which substantially increase the exemption amounts for the AMT that we got under the Tax Cuts and Jobs Act in 2017, were made permanent. The bad news, bad things come in threes. The bad news is the exemption phase out thresholds the inflation adjustments on the phase outs were wiped out. So those phase outs are rolled back to 2017 levels of $500,000 and $1 million. The increase, the phase out level back to phase outs, it's like sunsets and phase outs are the theme. The phase outs have increased from a 25% phase out once you eclipse those exclusion levels to 50%. So you find yourself in the AMT tax much more rapidly as you blow through those income levels. And then the increased deductibility of the SALT deduction is an AMT tax preference. So the end result is, if maybe you had experience and were exposed and had to pay AMT tax in prior years, certain high income taxpayers, particularly those with incentive stock options, high state and local tax rate deductions, or disproportionately large capital gains are much more likely to trigger the AMT beginning in 2026. So there's certainly some planning. If you fall into any of those categories, there's some planning and some illustration work that can be done going into year end to help mitigate that bite going forward. 529 education plans, I mentioned this in the introduction. Wildly successful, the 529 education savings plan platform. What we saw in the OBBBA was a loosening of the definitions of what constitutes a qualified distribution. In particular, K through 12 expenses beyond $10,000 of simple tuition or simply for tuition, much like a collegiate level beneficiary. So materials, tutoring, testing, beginning in 2026, that K through 12 expense limitation goes from $10,000 to $20,000 and encompasses not just tuition, but these other expanded deductions. And then what I thought was particularly interesting was an expansion to qualify expenses, education therapies. So for those that might be learning challenged or facing disabilities, physical therapy, speech therapy, occupational, or even behavioral programs will now qualify. I know we had a question ahead of the call about post-secondary education, vocational certifications, testing, licensing. Yes, yes, and yes. That was really the fourth expansion was, for instance, if your student is sitting for the CFP exam, reimbursement for those testing fees and those testing prep programs, or if they're going for a certification in a vocational program, those now qualify under the 529 qualified expense definitions.
That's
I know getting a little behind here. The next several sections, and maybe we'll just gloss over them very quickly, really focus in on some of the business owner provisions. We will cover them quickly. There's 4, I believe. The qualified business income deduction for owners of pass-through entities. If you recall, in 2017, when the subchapter C corporate tax rate was permanently cut from 35 to 21%, owners of S corps and partnerships felt like they deserved some sort of concession as well. So the qualified business income deduction under 199A was introduced. It's a 20% deduction against that flow through business income. Since the deduction has a relatively low phase out, roughly 197 single, 395, if I recall, in 2025 for married taxpayers, really coordinating the timing of income and deductions within a small business that's looking to benefit from this is crucial. QSBS, I'm going to use this as a little bit of a teaser. We are planning to have a session on the qualified small business stock, otherwise known as Section 1202. We'll have a session in the first quarter of 2026 to really dive more deeply into this, but essentially an expansion, a pro small business expansion of some very favorable tax provisions, shortening the holding period that's required to get a benefit of potential sale of a small business. It increases the amount of gain exclusion per owner of qualified small business stock, really taking that from $10 million to $15 million. And then it takes the what's referred to as the gross asset threshold, which is really the size of the business or the capitalization of the small business when it's created, from a $50 million maximum level to $75 million. Qualified opportunity zones provision, again, that was expires at the end of 2026. This was renewed and was modified and will be a real interesting arrow in the quiver of capital gain deferral and income tax planning going forward. This is really a 2026, 2027 planning item, but essentially the new law shortens the period which you can avail yourself of a deferral from 10 to 5 years. It has a favorable 5-year basis step up on the sale of the property. So essentially 10% of your capital gain goes away. And then if the replacement qualified opportunity zone property is held for 10 years, any post-contribution appreciation is non-taxable. That's what I've got for you, Kelly.
Is that it?
That's it.
Oh,
I know it's a
quite lot.
mouthful.
Thank you for covering all of that, Tim.
We just cherry picked the 970 pages.
That was great. So for those on the call that are just looking for sort of a year-end checklist item, items, things to tick through to make sure that they can sleep at night knowing everything that needed to be done by 12/31 is done and taken care of. Things that are not necessarily specific to One Big Beautiful Bill Act, but just sort of best practice year after year. What would you highlight for them and their advisors? This is something folks should be working with their advisors on.
Absolutely. We'll do a quick speed round. So, revisit retirement contribution deferral opportunities going into year end. Make sure you're maximizing where possible. Any sort of tax preference or deferral mechanism for sole proprietors, that would include, exploring SEP IRAs, SERPs, pension and profit sharing plans for longer term planning. But anything that helps either defer income into future years or accelerate deductions into the current year is certainly a good fundamental evergreen planning. Explore partial Roth conversion opportunities. 2 situations jump off the page. One is if you find yourself in an abnormally low tax year, partial Roth conversion opportunities to effectively fill up some of the lower brackets is a very efficient way to migrate future taxable IRA dollars into future non-taxable Roth dollars. The other opportunity in the Roth conversion arena it was really born out of another tax provision, the excess business loss limitation rules, which effectively converts certain business losses into individual net operating carryforwards. And to the extent that you find yourself with net operating loss carryforwards in your return, those can be a very complementary tax shelter to explore Roth IRA conversions. We talked a little bit about understanding the implications of bunching charitable donations into 2025. I'm just going to put it out there that we at HB Wealth have very, very talented advisors that are equipped with fantastic tools to help you go through this analysis, thinking whether it's year over year or maybe multi-year bunching. Always prudent year-end planning to really have a good strategic conversation around what your charitable intent is over the coming years. The hybrid of IRA planning and charitable planning, of course, is the qualified charitable distribution opportunity, the QCD opportunity for taxpayers that are 70 and a half or older. That gives us the opportunity to take up to $108,000 and direct that directly to charity. And in doing so, not muddying the water, not elevating your AGI within your 1040, that, as we saw in the tax law school fact pattern, can be quite murky. So
and those folks who are in RMD status, which not everybody eligible to do a QCD is necessarily in RMD status, but if they are required to take RMDs, that can be the qualified charitable distribution can be used to wash
that's absolutely right.
RMD.
You can check that box at the same time. So you're absolutely right. Spot on.
And on the topic of RMDs, because those are very year-end sensitive with lofty penalties if we miss that deadline, you want to speak a little bit to making sure folks are remembering to take their RMDs?
Yeah, I think you just did. So yeah, friendly reminder to take your RMDs, particularly taxpayers that find themselves collectors of IRA accounts, rollover IRAs, individual IRAs, making sure that you have clear understanding of what the requirement is, and that knowing that distribution, at least for 2025, is one of those stroke of midnight type requirements. Otherwise, you're going to be subject to some additional tax and penalty. Yeah,
and one important thing to note in 2025 is that for the last few years coming out of COVID, the IRS has had has not required the beneficiaries of inherited IRAs they haven't been so strict on the RMD requirement. Well, that changes this year. If you are the beneficiary of an inherited IRA, even if you're well under RMD age, you still have an RMD requirement, and you should be talking to your advisor to make sure you're taking that RMD.
Absolutely. There was a pause through the COVID years. There was a pause on inherited IRA distribution requirements. There was some legislative confusion as to what and when they would be required. That has been resolved, and those inherited IRAs now are subject to those distributions.
And just before we wrap up, I might also just add in from an estate perspective, whether you're taxable or not, there's a lot of people who think about helping their kids out with certain expenses, purchasing a home, just helping them along. And because we're at a point where we're about to have, 2 tax years, there's ways to use the fact that there are 2 tax years to really give in a really efficient way. So if that's something that you're thinking about, be sure to talk with your advisor about it so that we can make sure to take advantage of that.
Great point, Abby.
Absolutely, absolutely. Just a few last plugs on AMT planning. It's a scary, confusing topic. Again, your HB team is well acquainted with it and well equipped to do some very mathematical modeling, particularly if you're holding incentive stock options, looking at a potential 2025 exercise versus continuing to hold those options into 2026, 2027, with that potentially higher AMT tax liability. And then last, back to one of our favorite mechanisms, the 529s, just to reiterate with those liberalization of distribution standards for K through 12, and for vocational and post-secondary certifications, those do apply. Those did take effect July 4th of this year. So distributions made between July 4th and year end absolutely will qualify. You still are subject in the K through 12 distributions to that $10,000 hard cap in 2025. That hard cap goes to $20,000 in 2026. Kelly, I got to catch my breath. That's a lot of stuff.
That was a lot of ground to cover, and you did it beautifully, Tim and Abby. Thank you so much. Thank you, everyone who joined us today, for giving us an hour of your time to review what can be very dry, but hopefully we tried to cover a lot of ground as to changes that have been implemented under the One Big Beautiful Bill Act that directly impact year-end planning, and some of the year-end planning items that are best practices to visit every year at around this time, regardless of the legislative landscape. So thank you for being generous with your time. We are so grateful to have you as clients. And please don't be shy about reaching out to your HB team. We are here for you. We are on standby, and we love hearing from you.
And happy Thanksgiving.
Yes.
Happy Thanksgiving. Thank you.